For decades, gold has long been seen as the primary safe haven asset in times of uncertainty. However, a metal known for its industrial use is now making a significant and powerful comeback. Silver prices recently extended their weekly rebound. As of late November 2025, the metal is now nearing its most valuable position against gold bullion in almost 18 months of trading. This market shift is caused by industrial demand and geopolitical forces, not just traditional financial fear. We are diving into precisely what is causing this current chaos in the entire precious metals market right now. Silver today peaked within 10 cents of $54 per troy ounce, a significant milestone. It later fixed around $53.35 during London's midday auction time. Despite these strong gains, silver receives far less immediate attention than its more glamorous counterpart, gold. Gold bullion was trading close to $4,150 around that specific time period. The gold-to-silver ratio is a simple yet powerful measure of the relative price between these two metals. With silver strong and gold at that high level, the ratio dropped beneath 78 across the board. This marks the lowest point for the ratio since July of 2024, indicating a shift. The ratio spiked higher earlier this spring, following major trade tariff announcements by the sitting U.S. president. Industrially useful silver is now forecast to face a global supply deficit versus demand in 2026. The fourth quarter is typically the peak season for installing solar energy panels across the globe. Photovoltaics are cited as a major source for this increasing and critical silver demand requirement. The Silver Institute aptly refers to this essential metal as the indispensable element due to its unique utility. Stockpiles held in warehouses approved by exchanges in Shanghai have shrunk to decade lows recently. This depletion happened after dealers executed record exports heading westward towards London's markets. London, the center of the global silver market, is itself now facing a noticeable local silver squeeze. This local squeeze is directly attributed to heavy shipments moving out of London and into the United States. Dealers are anxious about potential import tariffs on silver being imposed by the current White House administration. This significant movement of metal began immediately following the president's election victory and his tariff promises. This new protectionist environment is clearly causing massive market dislocation and significant operational chaos. Market experts observe that removing the ability to easily move physical materials causes instant market disruption. The cost to borrow physical silver bullion in London has experienced a sharp and sudden increase recently. Lease rates for one-month silver deals climbed sharply to an annualized rate of 6.0%. This represents the highest rate observed in the last 2 weeks of trading activity across the sector. This is a massive shift from the near-zero cost that was typical for borrowing silver before 2025. Other key industrial precious metals that share this fate include both platinum and palladium for industry. These two distinct markets are significantly smaller when compared directly to the massive gold and silver sectors. Their primary value still comes from essential, high-tech industrial purposes across various global sectors. These critical industrial uses importantly cover military applications, aerospace engineering, and advanced medical technology. Platinum supply began tightening throughout December and into February, according to a senior industry executive. This tightening cycle began as the U.S. election results started pulling essential metal across the Atlantic Ocean. Platinum lease rates eased slightly, but remain highly elevated at 13.3% for borrowers. Palladium lease rates have also dropped to a still significantly high 7.5% for short-term loans. Trading has now officially commenced on China's brand new Guangzhou futures contracts for metals. This new exchange initiative directly supports China's stated national strategic priorities for materials. The exchange's mandate involves creating financial instruments that actively benefit the real physical economy. Given the Chinese government's strong focus on the energy transition, these specific metals are clearly prioritized. All this precious metal activity is happening while global geopolitics remain extremely tense in several regions. On Thanksgiving Day, Russia's President Putin called the U.S. peace plan for Ukraine a serious proposal. Putin indicated to reporters that they generally agree this proposal could form a basis for future accords. However, he reiterated the condition that Russia must annex specific Ukrainian territories not yet under their control. He warned that if Ukrainian forces do not leave those occupied territories, Russia will achieve its goals militarily. These strong statements coincided with the Brussels depository Euroclear pushing back against asset confiscation plans. The industrial precious metals market, led by silver, now shows its value is tied to real-world scarcity and industry. High volatility and rising lease rates are clear symptoms of this underlying market dislocation we see today. This current chaos is being fueled by strong fears of new protectionist import tariffs coming from the United States. Silver is expected to face a supply deficit in 2026, thanks to growing uses like solar power generation. While gold is key for diversification and traditional investment insurance, silver's current climb is telling. Silver's recent surge indicates the world is prioritizing the indispensable element needed for the energy transition. Global metal movement is threatened when the Western notion of fungibility and portability is seriously questioned. The ultimate driver here is the confluence of geopolitical tension, high industrial demand, and the fear of closed markets.